I've got a magic trick for you today. I've got this crisp $100 bill, right? And wait for it. $1 million. Totally not fake. Don't worry about the bits that say props. Totally real $1 million. And that's how compound interest works. Stay tuned for more. Hey guys, welcome to the Wealthy Idiots Show. I'm your host AJ. I'm going to talk to you today about compound interest. We're going to cover inflation. We're going to cover interest rates on a variety of different investments, and then we're going to head over to the Wealthy Idiots website and check out the compound interest calculator. And you can join me, play along. It'll be a great time. So let's jump right in. So for starters, what is compound interest? Compound interest is a fairly simple concept where the gains from your investments or any money made from your investments gets immediately reinvested back in. Over time, you'll see that the interest will grow, and we're going to cover exactly why that's the case. But before we go any further, I'm going to need you guys to go invest in the like button down below. That really helps us out. It helps out the YouTube algorithm to share this video around and hopefully get that sweet, sweet knowledge out to everybody that needs it. All right, back to the show. Let's first define gains, or what gains are when it comes to investing. Gains simply means the amount your investment increases over a period of time, typically referred to in a year's time. So we'll say your gain in a year or your yearly gains. We often use terms similar to this, such as yearly returns, return on investment, interest rates, and they often refer to the annual context or the yearly context. So my interest rate every year or my annual returns. And this is almost always described in terms of percentages, right? So if I invest $100 over here, I expect a 10% return. I should have $110 by next year. Real quick, let's look at a few examples of a variety of different types of investments, and we can kind of see what gains look like realistic gains in realistic types of investments. First I have is a high yield savings account, which returns 0.4 to 0.5% per year. That's half a percentage point. It's not very high. Next up, I have certificates of deposit, which is 1 to 3% per year. They usually have a minimum length of time that you have to invest for, so 6 months, 3 years, etc. And before I go any further, I want to talk about inflation. Inflation is often talked about in the news. I don't think a lot of people understand it, but we're going to talk about inflation. We're going to cover what inflation is and what that actually means to you. Inflation means the amount of cash in the market is increasing. Usually every year, the government prints off, or they have the feds print off some money, and then that money gets distributed in a variety of ways. Could be through government programs, could be through the banks, but generally the availability of products and goods and services kind of stays the same. So as money increases, this is the simple explanation, but as money increases and everything else stays the same, the laws of supply and demand dictate that slowly the prices will start to increase in order to compensate for the increase of money inside of our markets. Silicon Valley is a really good example of this. So where a lot of tech companies exist and a lot of cash is coming in and inflowing into Silicon Valley, we can see that the housing market has dramatically increased. But not only that, almost everything is more expensive here in Silicon Valley. Food, cost of housing, gas, pretty much anything you need to get around is much more expensive. And that's due to the influx, an increase of a significant amount of cash coming into this area, right? So inflation, when the government does it, is generally spread across the whole country, and you'll slowly start to see a rise in the costs of different things as time continues to go on. Inflation is estimated to be roughly about 3% per year increase, right? This is fairly significant. So that means that if you're normally going to the store and buying a candy bar, that $1 candy bar, next year will be $1.03. Now, if you're on the smart side, you've probably already picked up on that. If you put your money into one of the investments that I described before, you're going to see that you're basically losing money, or you're losing value in your money, right? So if you put money into anything that makes 3% or less, over time, you're not going to have it. The spending power of that money is going to slowly decrease, right? I think people kind of understand this in the sense of history. They don't understand it in the sense of future. So in history, our grandparents used to talk about going to the store and buying a candy bar for 5 cents or an ice cream for 5 cents. And then today you go and it's several dollars, right? So we kind of get that happens, prices increase over time. Well, that's also true for us. So if we stick money into one of these investments I described, or just put cash into the side, maybe in our checking account, we're going to see that buying power slowly decrease over time, an estimated 3% per year. So the question is then, why would you invest in one of those? Me personally, I wouldn't invest into a CD. Generally, CDs, because they require you to invest over a longer period of time, and they don't have that much of growth, you kind of have to stick your money in there, and then you don't see it for a while, and I don't like that. I do have money inside of a high yield savings account, and what I do with that is every time I get paid, I take a small portion of that and put it right into the high yield savings account. And then that's the money I use to plan on what I'm going to invest in next. So it's kind of like my holding area for where that money is eventually going to go. The reason that people might want to use these for maybe longer term investing would be because they're extremely low risk, or almost no risk. You'll put money in there and at no point will you lose money. And so they really enjoy that, the safety of having it there. You do lose buying power, but you don't actually get negative returns. So a few more examples I have written down here. One is government bond funds at about 5% return. So now we're actually increasing the value of our money through investing. S&P 500 index funds, 10% return. Pretty good. Mutual funds can be between 10 and 11% if you get a good one. It's really good. I know Dave Ramsey talks about the ability to find 12%. I don't know, maybe it's out there. And then some other types of investing, which are harder to find averages for, are things like dividend stock funds. So those are where you buy a share in a company in the stock market, but then that also pays you out usually per quarter. So 4 times a year you get actually paid cash. If you don't set it up, that cash will just sit there in a cash account. No interest is paid as a result, right? So you'll get cash and then it'll sit there. You can set up most online brokerages have the ability to reinvest that money into something, and you would want to do that in order to take advantage of compound interest for sure. But then also the share itself increases in value over time. But generally the companies paying out dividends don't expect the share to go up too much, which is one of the reasons they're paying out dividends. And the dividend amount also depends on the amount of profit that company is making. So it's a chunk of profit based off of the amount of shares that you own in that particular company. So this isn't consistent. It can fluctuate between companies over time, depending on how that company is doing. So I wasn't able to find good numbers on what you could expect as returns. Another one is rental properties, pretty good one. Returns can be pretty up there. I mean, it really depends on how you rent properties out, where you get the property from, or what location it's in. You can make quite a bit of money on rental properties, but not only that, rental properties tend to increase the amount that you make as time goes on. So you might start off making a lower percentage, 5 to 7%, and every year it might go up like 0.5%. And I can explain that more in future videos. I'm not going to cover it now, but just thought it was an interesting one to point out. And each one of these investments, depending on the return, has a variety of risks to them, and they have a pretty large swing. A swing meaning that you're going to see months or even years where you have negative value in these accounts, right? The money drops, it goes down. And overall, on average, it's going to be around the amount 5 to 11%, depending on what you're putting your money into. You're going to see years where it goes up pretty significantly, right? We saw a really interesting one this year with the whole quarantine, and we saw in March pretty much everything dropped down with the uncertainty. We didn't know what was going to happen, and then after that everything just slowly started to climb back up, and it went past where it was originally, especially the tech market, which was interesting. So if you had money in there, you made pretty good money. All right, so I want to hop over to the compound interest calculator, and we're going to take a look at how compound interest works on a graph, and we'll kind of cover the interesting details about that. And I want you to see the power that time has over investing and with compound interest. All right, if you want to track along, I'm going to go to the wealthyidiots.com website and click on the compound interest calculator. I'll link to that in the description down below, so go and check it out. You can play with it afterwards. I really enjoy playing with the compound interest calculator. I like seeing if I increase my investments, how much more will I make in the future. That really motivates me, and I hope that by you guys seeing this, you're going to get motivated too and join along and hopefully really get some value out of this. But we're going to start off with something really interesting. I want to put in $1,000 as my initial investment. So that's how much money I have right now and I'm going to put in. I'm not going to put anything else in to the additional contributions. And I'm going to put in 200 years as my length of time with an estimated growth of 7. So the reason I'm choosing 7 is because we can get a 10% return in things like the S&P 500 index or a mutual fund, but we want to minus the 3% average inflation per year in order to make sure we have a realistic number over a period of time. And I'm going to put in, oh, there you go. And you can see with $1,000 over 200 years, we have $752 million. That's the power time has over compound interest, right? Every year, the increase in our investment, that 7% is just going right back into the investment, or it's staying inside of our investment. We're not taking any money out. We're just leaving it in that mutual fund, or we're leaving it in that index fund. And we're just going to let that grow over a 200-year time period and kind of see where we end up. And we end up with $752 million. That's an effective $752 million if we can get an average of 10%, right? Minus inflation. So if you put in $1,000 now, your great, somewhere around there, grandkids are going to have big money. Where'd my $1 million go? They're going to have millions of these bad boys. And inflation by then means that we're probably going to have some of these at that point that are going to be real. I mean, this is real. Why are you looking at me like that? That's big time change. The other thing I want to highlight for you guys is you're going to notice the green line is the amount of money you put in. So if I highlight over a particular spot, it says that my total contributions have only been $1,000 because we've only ever put in $1,000. But the increase over time is that purplish blue line. Colorblind, leave me alone. And you're going to notice that there's very little separation between the two lines, going all the way until like 100, 106 years. It doesn't move a whole lot. And then we start to see it slowly creep out a little bit. And then somewhere around 156 to 166 years, we see that curve really start to take off until eventually it just shoots way up and we have $752 million. That's the power that compound interest has, that last curve, the end of your investment. It's that time it takes to get to that point where the investments can really start compounding on each other. It's also crucial why you get money into your investments as soon as possible so you can see the realistic growth, the real money that will be there later on in your life when you're ready to retire. So let's do something a little bit more realistic. We're going to see if we can invest $12K a year. So that's $1,000 a month. If we can figure out to invest $12,000 a year for a 35-year time period. So if you're 20 years old, that's when you hit 55, right? If you're 25, that's somewhere around 60. And we can see how that money really, or how much money we can get by the time we're ready to retire. All right, so we're going to start off with 0. We're going 12,000 a year. Oh, I broke the calculator, but we're only doing 35 years. There you go. So we could see that our investment amounts as time goes on, we're going to, 17 years from now, it'll be $204,000 is how much we put in, and $370,000 is how much money is actually going to be in the account due to the interest gained. And then our total is going to be $1,658,000. So 1.7 million, we can round up a little bit, but 1.7 million at the time of retirement. All you have to do is invest $12,000 a year. I know that seems like a lot, but if you make this your priority, this $12,000 a year your priority, that's the first thing that comes out of your paycheck, is to make sure that you get this money in there. Everything else comes secondary. Then you can make sure that you have this kind of money in the future for your retirement, and you can live comfortably. You'll have money to give back. you'll be able to live a really nice life in most of America with $1.6 million, $1.7 million. But yeah, get into this calculator, play around a little bit, kind of see what you can do, see the interesting types of numbers you can put in. Once I started to see what it was that was happening with compound interest, I started to get a little bit more creative with where my money goes, right? So I could see how much money I spend on food, how much money I spend on my vehicle, how much money I spend on housing, and you start to think about what can I shave off of that in order to add more to investing, because the amount of money or the money you put in now has a bigger impact than the money you put in later. So you got to get as much money in now as early as you can so you can get that real impact later on. We tossed in a few sort of test values here for you. So how much would you get if you invested $500 a month with a return of like 9.5? You would get you'd get $1.4 million for over a 35-year time frame. How much if you invested your daily coffee, right? So if you got $5 coffee every day, instead of getting that, you invested that money, you'd have $441,000 in 35 years. And if you bought a cheaper vehicle, so what we did is we looked up the average person's vehicle, and we decided, what if we shaved $5,000 to $10,000 off that vehicle and then invested that instead of getting that vehicle? It turns out to be about $3,000 per year that we invest, and we hit $725,000. And you can see the difference in between. We put in $105,000 and the account will have $725,000 in it, with an average growth of 9.5%. If you ever get stuck, you can hit our question mark here and see a couple of examples of some investments. We went with some low numbers so you could see some realistic returns, but feel free to toss in whatever number, just kind of see what happens. It's a good time. All right. Oh, well, that was a lot of information. Feel free to rewatch that if you'd like. Hopefully you get a grasp on some of these concepts. These are sort of the beginner concepts for investing and really getting going into this investment lifestyle of building wealth for your future and really putting it together. We learned a little bit about compound interest, inflation, and annual returns for a variety of investments. And then we discovered the real power of time. If your great-great-great-great-grandparents put in $100 200 plus years ago, you would be hundreds of millionaires by now. And they didn't do that, and that's why we're all sitting here trying to work super hard. And before you leave, make sure to give us a like, subscribe, check out our website. We got some great articles on there, and we hope that you find the information you need to really secure your future. Thanks for coming.